So in essence, what we're talking about is this thing called a delta reversal. Okay. Now I'm going to explain this to you with a basic concept. Right, and we're going to bring in this, this trend line again. So, in essence, what we've seen is this wonderful trend line. We've identified that over the last week, on the first occasion when we came to this price point, buyers stepped in. Okay, initially maybe they were passive. They provided liquidity to the selling backed off, and prices start to rise higher. Okay. At a later point in the week, we came back, and again this time, instead of it being maybe passive buying, we saw the sellers back off straight away, and the buyers get a little bit more aggressive. Okay. We then came back a third time in the rest of the week, and if you go look at the chart, which I'll show you on the next page, you'll see the third time they came back, we saw a lot of this. Okay, so again, we saw a lot of passive liquidity being provided from buyers. Sellers were happy to keep engaging at those low prices, but eventually the market facilitated higher trade. Okay, in other words, we can see on not just once, twice, but 3 instances, buyers are supporting the market at higher and higher prices. Okay, the moment we see that 3 instances, not 1, not 2, not maybe 2, maybe 2.5, but 3. When we see 3 instances of buyers stepping in and supporting the market, we can then draw a trend line. Now again, note, a lot of people go, oh, but the trend line's not pretty and it's not perfect, it doesn't fit the points. A trend line is not drawn to fit the points. A trend line is drawn simply to annotate that once, twice, and 3 times we've seen buyers interacting at those prices. Okay? In other words, they're facilitating a support at higher and higher prices. That's the interpretation of what a trend line is. Okay, now what we're going to look at in the next slide is we're actually going to come and look at the break point. Okay, and the reason is that when you've got a trend line or a support line, once we break down below that support provided by buyers, right, we're going to trigger something. Okay, in essence, we're going to trigger a bout of volatility. Why? Well, maybe the buyers have now finished buying and finished supporting the market higher. Maybe there's some stops in the market, or maybe there's just simply some very aggressive sellers that want to initiate very aggressively. Okay, but ultimately, we're going to hit a trigger point. Now, it's important, if you don't know how to draw trend lines correctly, you're definitely not going to know how to interpret trigger points, okay? Because a trigger point has some very specific details that are required to call it a trigger point. Okay, and I'll show you that in a minute. Now, the important thing to understand is that once we do trigger a certain point, right, there's going to be some positioning in the market. In other words, once we take out this price point, let's call it 40s, so 113.40. Or sorry, let's call it double O's, 114.00. Okay, once we take out this price point, we're going to see a hive of activity. So we're going to see a pickup in the volume. So if this is my volume, we're going to see that increase. We're going to see a pickup in the range of prices. So we're going to see a little bit of a greater volatility over which prices trade. Okay, and we're going to see price confirmation. In other words, in order for it to be a trigger, we have to see more volume. Why? Because if a certain price is triggering more people to respond, right, that response equals more volume. Okay, equally, that response equals more volatility. Why? Because there's more participants now focusing in on that price point. Okay, more volume, more volatility, and ultimately price confirmation. In other words, we don't want to see all this pickup in volume and all this pickup in volatility, but ultimately the market sells off and reverses straight away. Okay, we need to see the sellers getting rewarded for all that extra effort they're putting in. Okay, so that's the conditions behind a trigger point. We've got to see volume, we've got to see volatility, and we've got to see price confirmation. Right, we see those 3 things, we know we've now got a trigger in the market. And all the trigger simply means is that there is now some positioning in the market. In other words, there's some shorts entered into the market. Okay, now, again, a lot of people are going to say, yes, but this is a short-term strategy. It's irrelevant. It can be dealt with on a 5-minute time frame, a 60-minute time frame, a daily time frame. The crux of the matter is that trigger points exist regardless of what time frame you're looking at. Okay, equally regardless of what market you're looking at. I remember when Apple broke above $200 last year. Oh my goodness, it triggered just the biggest amount of volatility and volume flow in the market to the upside. Okay, so it doesn't matter the market, it's the interpretation of the principle that matters. Okay, so we've got these shorts in the market. This is the story now. Right, we've got a whole bunch of shorts entered on the break of 114. Right? In order for them to stay in, they need to see price continuing lower. Okay. Now, the fact of the matter is that once these shorts have entered, we shouldn't really be taking out that initiative point, that point where the trigger occurred. Okay? If we take out that trigger point, anyone that's short is now officially offsides. Okay? The market's going against them. So in this instance, what we're looking to do is we're looking to stay with the trend. And I'll show you this in a minute, just bear with me. We're looking to stay with this trend so long as this trigger point remains. Okay, it's very much a momentum play. If you were trading the euro dollar on Friday, this was the short opportunity of the day, and this was Friday the 15th of March. So we were looking to stay short, looking for the continuation, looking for the break of the inside day, just looking for a bit of opportunity. Okay, stops just simply above that trigger point. Now this isn't the play. The delta reversal's got nothing to do with this initial sell-off. I'm just painting the context for you. All right. But what we are aware of when we have these trigger points is we are aware of that line in the sand, that area that we shall not get above. Otherwise, shorts are now offside. Let's look what this looks like. Okay, so what you're looking at is the 30-minute euro-dollar FX in the futures. Again, doesn't matter if it's futures, doesn't matter if it's spot or forex or Apple stock or whatever you want to call it. The concept, the principle remains the same. Okay, we've got our buying initiative impulse a second time and a third time. Okay, those are the three examples I just illustrated to you. So three really significant areas of buying coming in, over the course of the week. Okay, this is 1 day, this is 2 days, this is 3 days, 4 days, and on day 5, all of a sudden, we had multiple support. And eventually on day 6 we broke the trend line. Okay, now this is the area we're zooming into. And we're going to zoom into this. This is a half-an-hour chart, but I'm going to show you what this looks like on a footprint in a minute. Now, the most important thing to interpret with regards to this trigger. Okay, I know a lot of you are going to say, yeah, but lots of these could have been triggers. Remember, a trigger has 3 rules. 1, we need volume. Okay, we can see that right over here. 2, we need volatility. Okay, we can see the change in price dynamic, a wider range of prices that we're trading over. Okay, and 3, we need price confirmation. We can see that red candle and red candle. Okay, that is our trigger. 113.95 is our trigger. 114. That's the point we're very interested in. That's the point we're going to take a look at. Okay, now for this strategy, by the way, the delta reversal has actually got nothing to do with the sell-off. The delta reversal is that up move. Okay, so we're going to look first at the sell-off, we're going to look at the breakout opportunity, look how I executed it, and then we're going to move on to the delta reversal, which is the second play of this. Okay, what you got in front of you is a footprint chart. For those of you not familiar, get familiar. Okay, this is the tool of the century now. This is what professional traders are using for very good reason. Okay, so the first point we're going to pay attention to is that the attack. We're going to pay attention to the attack of that 114 area. Okay, we're going to see how the market reacted in that space. And it all starts with a gradual sell-off. So we can see around about the 114.08, we could start to see the market gradually pick up. And we can see that by volume. Okay, notice the histogram, suddenly 2 times the average volume. Right? Again, we can see prices navigating lower. By the way, each one of these little, histogram bars or whatever is 5 minutes worth of time. Okay, so what we're looking at in essence is we can see the market gradually starting to drift lower. Gradually, not selling, just drifting lower. We see no real sustainable volume, just a one-off. One-off selling, a little bit of selling, again a little bit of buying, a little nothing really going on, and then suddenly again the dynamic changes. Another 1,000 lots through, another 1,000 lots through. Okay, so all of a sudden in the space of 20 minutes we can see 4,500, 5,000 contracts trading through the market all around that trigger point 114. Okay, so it starts around about this 12:35, 12:40, time, and we can see that the market suddenly gets a little bit more aggressive. Right? Notice the volatility shift. So notice the range of prices over which we trading sort of a half an hour before versus once we take out that 114. Okay, notice the price direction. Notice how markets are opening at the high of the rotations, closing at the low versus previously. So the dynamic has shifted. Okay, the interaction has just altered slightly. Now again, this is not the most aggressive selling. Trust me, I've seen more aggressive selling than this. But it's that shift in interactions, that shift between the buyers and selling that's giving us that clue. Okay, 114 now is broken. The trend line is broken. It's time to enter shorts. Okay, and we can see that. We get our entry point at that 95s, and we can see the selling start to pick up. Again, we saw a little bit of buying initially, but notice rejected straight away. Okay, and that confirms it to us. The moment we saw a hint of buying, very next rotation, a lot of volume and a lot of aggressive throughput. Okay, so really, really intentional selling coming through there. Okay, just confirming that breakout, confirming the break of the trend. Okay. If anything, if you weren't filled early on, if you weren't too aggressive, it came back to give you a fill around those 114 area. All right, market continues lower. Now we've dropped off again. A lot of you are going to say not significant. It's only 12 pips. Right, but bear in mind, guys, the average range in the euro dollar at this point, I think it's like 42 ticks or something. The average daily range. Okay, so 12 pips in a 42 pip range is pretty decent. We're talking what, 25% of the range? Okay, so 25% of the range in a space of 6 minutes. Okay, now the market starts to grind again. So we're not perplexed here. We're not annoyed. We're still short. We stay short until 114 breaks. Okay, market starts to grind a little bit higher and a little bit higher and a little bit higher. Right. Now again, if you're someone that's intuitive and you watch price a lot, you'll know when we have a key break of a trigger, the market should not be grinding so slowly. If anything, key breakouts are very much time dependent. Why? Because once we break that 113.99 and 114, we should see a lot of volume, a lot of volatility, and a lot of selling coming through. Okay. The fact that we're not seeing a lot of volume and a lot of volatility and a lot of price direction is telling us that this trigger point is not as aggressive as we would have liked it to be. Now remember, this is a mistake I made early in my career. Just because the market isn't responding 100% the way you think it should, doesn't mean you don't have a relevant trade strategy, okay? And that's where you've got to be disciplined. That's where you've got to say to yourself, well, look, 114 is the trigger. I've entered pretty much at 113.98, 113.97. I've got to stay short until, the trade has become invalidated. Right? And that's not going to cost you a lot in this example. If anything, you're talking 5, maximum 10 pips. Okay, for a potential breakout opportunity. So it's a very small, tight stop on this trigger trade. All right. In essence, where we are stopping out, the moment we come back into this trigger point, okay, and we start to see the market move sideways. In other words, the market's come back to test that breakout point, but now it's starting to accept a lot of volatility, a lot of trade. It's accepting trade at the breakout point. That's the big red warning flag. That's telling you, be very careful. Why? Because if we are correct, if this is the point that sellers have engaged in, why are they not engaging anymore? Why are they not selling the market back down? More importantly, as you can see in this example, the sellers are engaging. Okay, that's why we have the sufficient amount of volume. But guess what the buyers are doing? The buyers are also engaging, and they're engaging at higher and higher prices. Okay, so it's that interaction that gets us out. It's that interaction that says, hang on a sec, prices have come back to where sellers are selling, but equally, the buyers are buying even more. Okay, and that's the clue. It's the price combined with where that interaction is taking place that's giving us the clue it's time to get the hell out. Now, this is where the delta unwind comes in. Remember we said we've got short positions in the market. We have that confirmed by this big red negative cumulative delta of minus 2,200. Okay, so we know now there's shorts positioned in the market. We could see those shorts around that trigger point of 114. The moment we start to bid up above that trigger point, we're going to start to see the shorts unwind. Okay, once we got above that 114.03, okay, so the top of where those sellers are selling, that's where we initiate the longs. Okay, stop limit orders. We're looking to buy now and hold. Why? Because we're going to get a delta unwind. In other words, you're still going to get a positioning unwind. Now, very simply, a lot of you are saying, what does a positioning unwind look like? I'll give you a clue. You see this volume here. Okay, we go from 1400, which is high, relatively high, to almost 2.5 times. Okay, that's the process of a delta unwind. Equally, we'll see the interaction. We'll see it going from selling to buyers very aggressively lifting the offers, just trying to get out, lifting whatever off they can. Okay, that is the delta unwind right there, all the way from 114.06s all the way up to 114.23s. Again, a lot of you are saying, well, it's not that much. 18 pips. 18 pips in a 42 pip range. 50% of the range, guys. Okay, you're not going to get much more. That's the crux of it. A lot of you are going, yeah, but I'm a swing trader. I need to take big moves out of the market. Well, guess what? The Eurodollar's only offering you 42 ticks. So take the damn 18 ticks, because the delta unwind is a very good strategy, and I'll show you why. Okay, if we're entering on the break of that 114.04, where are we stopping out? Okay, very simply, we're stopping out below the base of where those buyers are being very aggressive. So simply 114 figure, 113.99. We're talking about 4 pips here, guys. 4 pips for a delta unwind. That's all, 4 pips. You don't need 40 pip stops. You don't need 50 pip stops. What you need is a strategy that gives you the precise access point to access a trade opportunity with risk that invalidates the trade. Okay, note, I'm not going, I think it's long, I think I want to go up, I think it's a buy because of blah, 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 blah. I'm telling you it's a buy because there's shorts positioned in the market. We can see where they entered in the market. Once they start to be overrun, we're going to buy with the stops, and we're going to simply stop out at the point where the buyers began to become aggressive. Simple as that. If it takes out that 114 figure, we know that the buying impulse is not as strong as we expect. In other words, we take our 4-pip stop and we sit back out. Okay, now I should show you, I mean, obviously the market does come back a little bit, and again, it goes again. So we had another little push higher. I was definitely not in for that second push higher. I was simply just getting out of that 114.21 when the stops went off. Market did continue on higher, and we took out the high of the day. Okay, what's the lesson of the story? Well, what are we trying to take away from this? All right, it's very, very important, and this is the crux of the matter. We can all see this trend line. Okay, not everyone knows how to draw a trend line. If that's something we need to discuss next week, hit me up on Twitter. Okay, ask me, please do a whole lesson on drawing trend lines, and I'll show you how to draw proper trend lines. Not this, connecting the dots. That's a lot of rubbish. Okay, the point is that when we have these trend lines, we're not so interested in the trend line. We're interested in the trigger point that trend line presents. Okay, we have to see confirmation. We have to see some interaction that tells us you've got a trigger point, and we know what that is because it's volume, volatility, and price confirmation. Once we get that confirmation of a trigger point, we're then very aware that we stay with the trend, with the momentum. Okay, we're not looking to, just find a delta reversal. We're looking to stay with it. If, however, once that trigger point's executed and we cannot sustain and the market comes back above it, we then get switched on for the potential for a delta reversal. Okay, that's the move we're looking at. That was the capture. That was the opportunity. All right, now what I am going to say, just a few little notes. Never preempt a delta reversal. Like I said, stay with the trend, stay with the momentum. If it comes back above that trigger point, then we get cracking. Okay. The axis point's unique, and I think I showed that to you. The axis point is just simply that point which validates our entry point. In other words, it validates the opportunity, i.e. we've got a trigger point on the trend line. When we see that pickup in volume, volatility, and the change in dynamic and interaction, we enter. We stop out where? Where that axis point is invalidated. Simple as that. Risk management like ABC. Simple. All right. The opportunity is obviously in the unwind of the positions. I showed you what that unwind looks like. It's simply just a big shift in volume and a big change in price. Okay, that is our stop unwind. Once you get that big change in volume and price, we simply take our profits. Okay, and do note this is very much a momentum volatility play both ways. Okay, it's you have to be aggressive. You're not going to get paid for sitting on the bid, leaving limit orders. You're going to have to lift the market, lift the offers, or sell into the bids if you want to take part in the strategy.